So that's become his de facto office. And he sits there. He spends the first 2 hours of every morning taking his orders that come in. He has food, snacks, and juices and drinks. And then he has his tuk-tuk parked outside, jumps in, does all his deliveries. And that's a real example of how the SME growth is coming in using, well, this is more of a commercial storage facility, but that it's a practical solution, whereas previously, you had issues of security and cleanliness, hygiene, all of these coming in. Now that renewed focus is very much in line with these practical solutions that we're seeing.
Thanks. Murray, sorry, I don't know. I don't have a clue how we're doing on time. To what time?
We've got about 10 minutes.
Okay. Can I just check, are there any questions from the audience at this point? Okay. Mark, now I'm going to ask you an easy question. But you've done really well with the difficult questions too. So, but let me throw an easy question out there. What do you think, I mean, you're right here in Nairobi. What do you think are the main themes at the moment that's shaping the market fundamentals?
I'm evangelical about Nairobi. So, I just moved back from the Middle East, and it was a decision that took a little bit of consideration on my part, but I'm hugely bullish about Africa, East Africa initially, and particularly Nairobi at the moment. And I think, interestingly, and I hope I'm right when I say this because it's very difficult to track, but during and across the pandemic, I was concerned about what would happen with security on the ground in Kenya and the broader African piece, but particularly in Nairobi, given the spike in unemployment, or at least the perceived spike in unemployment that would occur. But actually, Nairobi's a much safer place than it used to be, certainly when I was growing up here. So, I think security is certainly getting better. Infrastructure, as was discussed earlier, and real estate is an ecosystem, and I think Nairobi is getting to the stage now where it's developed this kind of diverse ecosystem of infrastructure, and then the different types of asset class mix across the different nodes. And I don't know many global hub airports, and fine, maybe I'm exaggerating calling Nairobi a global hub, but you can get to New York from here, you can get to London. I'm flying to London with Kenya Airways tomorrow morning. You can get around, and certainly around Africa, and now it's only a 10-minute drive from the CBD, and that's pretty unique. We've obviously got the BRT coming as well. There's the redevelopment of the Kenya Airways site in central CBD Nairobi, and there is apparently a tangible plan to redevelop the airport as well. So I think the key to, if you look back through history and you look at markets like Hong Kong and London, Singapore, and Dubai, now a more recent example, the infrastructure is the key to the development of the market, particularly the airport. All those cities have big hub airports with national carriers that bring people into the market. So if KQ can continue to improve routes but also service, the airport can upgrade, the road infrastructure continues to improve, the rail infrastructure is improving, I think there's a lot of positive energy around this market. And I think if we're looking about the future of real estate, there's obviously all the nuanced changes that are going to happen to high density residential developments, whether they're going to have offices built into them now for this work from home thing, whether the office is going to be what it used to be, or it's going to move to some sort of hub and spoke model where you have your brand head office and then you have little hubs in different the little spokes in different residential areas. We don't know, but the key to unlocking all of that is creating an environment where it's easy for people to come and do business and live. And Nairobi's certainly ticking those boxes.
Okay, thanks, Mark. Before we hear what the experts have got to say about the subsectors, I want to ask Karine one question that came that I found very interesting when we had a discussion recently. Do you think there's elements of African design and materials and techniques that can come into green buildings going forward?
Absolutely, yes. I think, first of all, if you think about traditionally how we built worldwide before the advent of air conditioning, that was innately the passive house, right? And I think a lot of design elements that are traditional to Africa, you'll see them coming back into play. Courtyards, natural ventilation, natural lighting, but also local materials. We've got in Africa some really renowned architects who have, for instance, the winner of the Pritzker Prize, Francis Kéré. He's a proponent of, what is it called? Hang on, not packed earth.
Check notes.
Excuse me, I've got it down here somewhere. Rammed earth. And, things like laterite as well, stuff that you get locally and that actually can deliver long-term energy efficiency benefits as well as being recognized, particularly by the EDGE certification for their lower carbon content. And as we do see policies moving more in the direction of zero carbon, that's going to get more and more important, and we're going to see more and more of these elements cropping up. I'm just going to add to that as a kind of overlay on what we're seeing emerging sector by sector. And I apologize for yet again mentioning a McKinsey report, but I do recommend, there's something out by by McKinsey. They published it in February from their Global Institute, and it's climate risk and opportunity for the real estate sector. And you'll find in that report a lot of challenges around the way that folks right now are valuing assets in the sector. And as I said before, this is going to come into play, I think, more quickly than many of us imagine. Just on this visit, I've been talking to developers who have been saying, it's surprising. Folks that are buying my units are now asking me at the retail level, what are my green elements? And, even for somebody working in the green building area, I find this visit is teaching me stuff. Things are moving so fast.
Okay. All right, so let's quickly hear about the subsectors. I think we need to be brief, probably a minute and a half each. Let's try and tell the audience something that they can't read in a McKinsey report. Maybe, Kenneth, let's start with you on residential. Human, if you can comment briefly on retail. Jeffrey, industrial, and then a nice one, hospitality. Mark.
Thank you. I think looking at the region, if we look at the market demand, so there is if I combine the 7 countries in sub-Saharan Africa, the housing gap is 48 million units. If I combine the East African countries, it's in excess of 7 million. If I take Kenya and Uganda, it's more than 2 million residential units. If I look at the supply, it's less than 200,000. Anyone sitting anywhere across the world is wondering why that gap has not been met. And speaking to what we are speaking of scale, investors out there are looking for ticket sizes of $250 million and above. So from Centum Real Estate, what we are doing is to try and organize a business that can supply 20,000 units per year and above, and now provide a scalable business that any international investor can come and invest in. So that data maybe is not in the McKinsey research, but it's part of things on the ground.
Thanks, Kenneth.
So, I think from a retail perspective, it's always a chicken and egg situation, and we have much longer lead times because the development and planning that goes into it. But what we are seeing as a future trend is, first of all, I think we're at a position now where there probably is increasing demand coming about to probably exceed supply. I think in the next 24 months. So we've seen kind of the reverse of that, especially in Kenya or in Nairobi. But supply is now falling below what's coming in from global demand into the area because of some of the points that have been pointed out by the panel, and just Africa becoming more and more important in terms of some of these global brands looking to have representation and get in as early as possible. So I think beyond that, there will be more and more interest in the the street level retail coming in rather than big box. So you can have quicker and easier and more flexible solutions. I think that I'm surprised that we don't have more flexible spaces that can be even combined and used by multiple retailers who might be present on an e-commerce platform through social media, and then actually have physical presence for a week or two, so that they can actually have a touch point with their customers. I'm surprised that that's not fully developed yet, but I think that could be very interesting in this market.
Thanks, Jeffrey.
So our product is relatively vanilla. We build warehouses that are available for SMEs and multinationals. The concept is to create an enabling environment where people can access it quickly. So we've already built it. So you sign a lease on a Friday, you can move in on a Monday. There isn't a huge lead time for us to build it for you. The power doesn't go off, the site's secure, you're amongst like-minded people, so you create an environment that's very positive and hopefully a center of excellence. The challenges that aren't in the McKinsey report in relation to Africa are, it takes us twice as long to build in Africa than it does elsewhere in the world. It costs us significantly more in Africa to construct than it does elsewhere in the world. And the biggest bugbear of all is to actually secure, our investment is $150 million per site when it's fully opened. So you've got to do it step by step, you've got to do it thoroughly, you've got to do it very for the long term. Africa is a long-term investment for us. The biggest challenge is actually getting sites and getting the title deeds on those sites so you can actually build it. So I think the market is huge in Africa, the opportunity is huge. The challenges are the African challenges of the cost of construction, the amount of time it actually takes you for permitting, putting the project together, and getting the keys actually available to give to customers, and thirdly, clear title to land. So if those three issues can actually be addressed, then it's all easy sailing from now on.
Okay, Mark, easy one, hospitality.
Thanks. I'm just going to say to Jeffrey, don't ask anybody about the lands department in Nairobi. Not a Kenyan anyway. Look, I think, as I said earlier, real estate full stop in every city is an ecosystem, and hospitality is a key element to that. We're very lucky that in Kenya we have this unique combination. It's not totally unique. Lots of places have beautiful scenery and places to go, but we have the unique sort of safari in East Africa, and we have this kind of business hub in Nairobi as well. So we got this good blend of corporate and leisure travelers. I'm also very fortunate that, although very recently I've taken over this very diverse company, that, we kind of touch every point of that ecosystem from a real estate perspective. And what's been really intriguing is to see the return for retail and hospitality, which were the worst hit during the pandemic, but they're also the first to come back. So they're the most, I guess volatile is probably the right word, but that means that in times of sunshine, they're really, really successful, but then they were the first to kind of fall away under COVID, whereas the more traditional and sort of more cumbersome asset classes are slower moving, and we're going to see resi come back post the elections. We've been, I was talking to Jeremy earlier just before he left about the elections, and every single time we have an election in Africa, but also in Kenya particularly, everything kind of slows down. we had an EMEA call about Q1 results. Well, actually, it was the last kind of 9 months worth of financial results. And it was interesting to see that globally, most markets started to come back last year. In Africa, Q1 has been pretty strong, except for in Kenya. We've been hamstrung by this election. So there's this post-COVID pent-up energy towards all the different asset classes that is shining through in the asset classes like hospitality and retail performance, not necessarily in investment. But as soon as this election is put to bed, I think we're going to see a really big turnaround. I mean, one caveat is the base is going to be low, so the growth figures are going to look great. But I think it's not going to take us long to get back to where we were.
Great. Thank you very much, everybody that's on the panel. Certainly very insightful to me. Thanks.
Thank you.
All right, thank you so much, Gerhard, and your panel. I'd like to request the media to step out for the press conference that is happening right away. Once you get out this way, walk towards the extreme left, where you'll find the room where the press conference is happening. Members of the media, you can take a short break into the press conference, and then you can come back right after. All right, we'll move quickly on to the next session. And for that, unfortunately, the State Department of Housing was not able to make it for the next session, but we will have Gikonyo Gitonga, Managing Director, Axis Real Estate Limited, who will join us on stage for us to just get a quick insight on what's happening around the Kenyan government's affordable housing projects, and a little more about what the government is doing to encourage real estate development in the country. Let's give a warm round of applause to Gikonyo Gitonga. Karibu sana.
Thank you very much.
All right, thank you all so much, Gikonyo. Thank you for joining us up on stage. We'll just quickly get into it. The Big Four agenda was very deliberate about a housing project and different housing projects within the affordable space. Could you just tell us a little bit of an update of where we are? And I know you're not government, but you are in the space and you are able to share with us a little update from that sector.
Thank you very much, Terian. I heard that the press were being told to go to the next room. I hope all of them have left.
So you're safe.
Because I'm not speaking here as representing the government, but my role is that I'm a director of the Kenya Property Developers Association, and I'm also the chair of the Land and Physical Planning Sector Board at Kenya Private Sector Alliance. So I've been very involved in trying to articulate the private sector position on issues related to affordable housing. So my shirt does not represent my political affiliations. So please note, I chose the color of this shirt very carefully, Mark. So please remember that. So, as you all are aware, in 2017, there was after the current Jubilee government was elected, they came up with the Big Four agenda. And that was in around December 2017, after when the president was sworn in, they came up with the idea of the Big Four. I think it has been a very big journey. It's been a challenging and trying journey for the government in trying to deliver on the Big Four. today, yesterday there was an article in the Business Daily which said that were able to increase 93 affordable housings last year, and they have reached to 2,613 out of the 500,000 that they had tried to achieve by within 5 years. So all of you are good in maths. You would be able to determine what's a success. But I'd like to turn this thing around more to a question and a debate on what you as developers, as practitioners in real estate, why hasn't there been an uptick in the affordable housing? The government has come up with incentives on tax. They've offered land. We were in a very interesting conversation last week. And one developer said he won't take land from government. So I don't know whether, because I have my own views, but maybe it could be an open discussion. And maybe members of, and I could try and answer some questions that maybe that could come from people.
All right. Do we have a roving mic in the audience? Can we get a roving mic in the audience? All right, before we do that, Gikonyo, you've just talked about the incentives, and I'm curious about how they work in practice.
Yeah, that's the big challenge, is that in practice, they are on paper. So a lot of there were some tax incentives that were given that if you developed over 100 houses, you got some VAT exemptions and you got some corporation tax reductions. But from what we understand, only 2 developers have actually applied for them. And that's why we as the affordable, at KPDA, we've set up an affordable task force, trying to look at what are the bottlenecks of this being able to achieve or to apply for these tax incentives. Because although they are there on paper, on practice, the process of trying to apply for them can be very challenging. And it's a minefield for most of the developers. I don't know whether there's any developer who has, in this audience, who has developed any affordable housing. Show of hands. Maybe a roving mic could go to him and he could give us a bit of discussion to... Maybe you could introduce yourself and then just tell us how it has been.
Well, yes, my name is Sebastian Dietzold. I'm going to be in the panel this afternoon. I want to tell you more about affordable housing we do in Tanzania. So affordable housing is possible, but it needs things like incentives, of course, help. In Zanzibar and Tanzania, the government incentivizes for us, for instance, import costs and VAT and other things. But it's important for us to enable us to build large scale, and I'm talking about large-scale affordable housing because I don't think we have small-scale affordable housing that is possible. It's about scale, it's about sustainability, right, and about technology. And that's what I'm going to talk to you about this afternoon, right? So yes, we are doing affordable housing in Tanzania, in Zanzibar. We've built more than 1,000 units. Starting price around 1.5 million Kenya shillings for a small unit. But we don't believe in affordable of just being very cheap or very, very low priced, but we believe in developments being inclusive. So you need to have urban developments that have entry-level products to luxury products, and combining those will also help to cross-finance the entry level. So yes, it is possible, and governments can play a big role in supporting the sector.
One, two. All right, thank you so much. Mr. Danford, I'm going to have to share my invoice. You're going to have to share an invoice with me, but thank you so much for stepping in at that point. Let's talk about affordability and entry level. From the projects that were done in Kenya, and they're at scale, were they entry level? What are the price levels like? And was that, a mitigating factor for developers?
So when the affordable housing plan was put together, they were trying to look at trying to get a house below 3 million Kenya shillings for a three-bedroom, and then 2 million and 1 million. So the cap was given first at about 3 million. They've raised it a bit and said it maybe affordable housing can come up to a figure of about 4 million. I think the debate, there's been a big debate on what is affordable. Is affordable the price, or is it, are we determining it on the basis of what people can afford to pay? The challenge is that when you look at Kenya's population, we have about a workforce that has got a population of maybe 18 million people, but only about 2.5 or 2.6 are actually in formal employment. So what happens to that big gap of 16 million? How do we determine what affordability is for them? And when we talk about we have a housing shortage, are we saying that these people don't have a house, or is it that it's not decent housing? So there are very many schools of thought about the affordable housing, and I think in the last 5 years, the government are still trying to come to grasp with some answers on this. It would really have been nice to have somebody from the government or from the State Department of Housing. Most of them are currently at the Afri-Cities summit that is taking place concurrently in Kisumu. But this conversation is going to continue. The only question is, will it continue post-August the 9th? We will have a new government in place, we'll have a new leader. Are the new leaders talking about affordable housing? Unfortunately, I don't seem to see any of the political leaders talking about progressing with affordable housing. But the good thing is that for the last 5 years, we've been having this conversation about affordable housing, and we recognize that it's a big problem. The next thing that we are now starting to appreciate is that we have also to have to deal with urbanization, because urbanization is housing is part of that subsector. So the numbers could change, but initially it was at 4 million.
All right, do we have any? Yes, we do have somebody right at the back.
Good afternoon, my name is Lucy. Maybe Gigi, for this conversation, and as we're speaking about the trends post-COVID, immediately COVID hit our country. There was a very serious conversation online with regards to people trying to get discounts from their tenants. And earlier in the presentation, the gentleman from Centum Real Estate pointed out that most of the urban dwellers are renters rather than homeowners. A couple of the projects that have been going on in the affordable housing, I was involved in one in Pangani. The developers are putting up houses in partnership with the government, part of it being the county government of Nairobi, who own the land, but the end product is to be sold. Is there an opportunity for government to continue being an owner, potentially, so that the affordable housing simply gets to the end user as tenants rather than trying to get people as owners? Because what was happening in the project, we had to vet people based on their salaries to see who qualifies for an affordable unit. But the demand was out of the normal. I mean, people who can afford non-affordable housing are the people who are coming to purchase. But those who really need to be impacted by the affordable housing are not able to purchase. Then can we have the government holding the property for the long term and it's simply out in the rental market rather than in the home ownership for us to be able to sort the gap And sectional property comes with its own challenges with regards to maintenance. So as you sell some of these affordable units, people are then thinking, wait a minute, there's a service charge. We're trying to do density, lifts come into place, a lot of facilities come into place. So the life cycle maintenance of those quote unquote affordable houses then exit the gap for affordability. Should we be looking at a space where government owns the property, holds the property, and simply leases it out to the tenants?
What are your thoughts, Gikonyo?
Wow. Lucy has asked me so many questions. Lucy, I'm not as young as you used to know me, so I can't remember all your questions, but I'll try and answer them. First thing, I'll let you know. I had the benefit of working in the government during my younger days. One thing you don't want to do is for the government to own houses and rent. The government don't know even the houses they own. They don't have a good inventory of it, and they've accepted it. They've admitted it. It's been a subject of internal audit by the director, the Auditor General, that the government does not even collect rent from the civil servants who occupy houses owned by the government. So if you try to get that, it will be a big problem. Next is that government should be an enabler to achieve affordable housing or housing. They're not in the business of being landlords. So that's, unless somebody has got a contrary view to that, that's my belief. They should not be. The challenge about, or in my view, I think the government's push for affordable housing was that we want to provide affordable housing for people to own, which I think that was not the right direction we should have gone to. I think the direction now we should, and you'll find that a big percentage of Kenyans rent homes. So, and now what is happening is now we are starting to get to see a shift. And there are some investors who have come into Kenya who want to buy, who want to own the affordable housing and rent them out. So there are going to be various investors who will now be looking, and what we should be looking is to having developers who can develop to long-term investors who have got patient capital and then rent them. Even if you look at some of the affordable housing that has been done, like the one you mentioned in Pangani, you'll find that most of those houses have actually been bought by investors who then rent them out, because there's a big demand for rental housing. And that's where the challenge is. And I believe what we need to ensure is that there is decent housing. And even when it's coming to decent housing, is how do we ensure that these housings are very well managed? Because a lot of developments on housing, they have not taken into consideration on how those assets are going to be managed. When you look at lifts, when you look at service charge, collection of service charge, any developer will tell you today that that's one of the biggest challenges. When you, in some of the subleases or under the Section of Properties Act, there has not been proper provision to allow for a sinking fund, so that when the development becomes older, you must need to replace the lift. And you will find people who will just say, I live on the ground floor, I'm not going to contribute to the lift because I don't use the lift. And the guys on the upper floor say, if it leaks, the roof doesn't have to be repaired because I don't live there, so it's not raining on me. So there are big challenges, and the mentality of looking after assets has not been very well done. So I think those are going to be the big thing about how do you manage these big high-rise developments, where are we building slums or something of the sort. So I think there is also need to be development of affordable housing for rent, not just for sale, for ownership.
All right, thank you so much. We'll wrap this session at that. Gikonyo, thank you so much for giving us an insight into what has been done so far in regards to affordable housing and what we as stakeholders, or the role that we as stakeholders can do in working alongside government to hopefully make this achievable.
Thank you very much.
All right, thank you so much. Let's give Gikonyo a warm round of applause. Asante sana for stepping in to have that chat with us. Up next, we have Wayne Godwin. Wayne is a head for East Africa and Indian Ocean Hotels and Hospitality Group at JLL, and he will invite his panelists, and they will focus on foreign investment and institutional capital aspiration. Wayne, karibu sana.
Thank you very much. If my panelists could start making their way, and we can do a proper introduction. Great, so thank you very much. My name's Wayne Godwin. I lead JLL's business in East Africa. I also look after the Hotels and Hospitality Group. Yeah, and we're here today to talk about investment, particularly institutional and international investment into East Africa. Now, I realize that those two are in no way a homogenous group of investors, so we're going to focus a bit more on the institutional side of international capital and how it's looking at the region. Now, what's great about my panel here today is that we really are looking at it from a number of different perspectives. We've got pension fund capital, we've got private equity, commercial debt, we've got DFIs. So it's fantastic to be joined by my colleagues on stage here today. So I'm actually going to let them do a quick introduction to themselves, a bit about where they fit into the sector, who they are, their company, and then we'll take it from there. Godfrey, you first.
Thank you. I'm Godfrey Tapela. I'm a senior investment officer for IFC. I focus on a number of real estate sectors or related sectors, specifically tourism, which is hotels, retail, commercial property, which is a bit wider sector in that it includes industrial warehousing, industrial parks, especially economic zones, offices, shopping malls, and then lastly, the key sector of affordable housing. I focus on East Africa, based in Nairobi. Thank you.
Thank you. My name is Pius Mushiri. Good morning. Good afternoon, everybody. I am the managing director of Nabo Capital, part of the Centum Group. At the group, we are involved in real estate. It's actually the biggest asset class within our portfolio holdings. As Nabo Capital, we play a critical role in not only doing the fund management side, but also in capital raising whenever those opportunities mature. Yeah, thank you.
Charles.
Yeah, my name is Charles Kanuki. I work with Britam Asset Managers. I deal particularly with the fund management component and specifically the real estate angle. So we do real estate investment advisory, structuring, and the whole spectrum of sourcing for capital and deploying it in real estate. Thank you.
There it's on. I'm Gerard Zili. I am from Nedbank Property Finance. Nedbank in South Africa is the largest financier of commercial property finance in South Africa, probably twice the size of its nearest competitor, and we're looking to replicating that dominance in the rest of Africa as well.
Good afternoon, everyone. My name is David Wafula Luigi. With Gen Africa Asset Managers, we are a local fund manager managing about $3 billion, both in Kenya and Uganda. I'm currently running with our real estate mandate, where part of what we are invested in on behalf of our clients is real estate. Thank you.
Great. So before we get a bit closer to home and look at East Africa, I think it's important to just take a second to realize the extent to which this capital competes globally, both attracting, importing, and exporting of this capital, and just kind of talk a bit about what's happening globally. You know, I think real estate has had a phenomenal start to the year from an investment point of view. Q1 investment volumes are at a record high from a quarter perspective. What's really fueling this? Well, obviously a lot of liquidity, a lot of dry powder on the sidelines has been able to pivot into real estate, and occupier demand coming back strongly. Certainly from a commercial perspective, logistics very strong. We've heard about the shift from e-commerce, a lot of government stimulus that ended up in consumer hands, whether it's the Trump checks or the rest, and a lot of that's gone into e-commerce channels and really kind of spurned that growth in logistics. Living been very strong, but I think some of the headwinds we'll talk to will be particularly apparent for that sector. Hotels and hospitality, very strong quarter, has seen a lot more recovery as global travel comes back. And similar retail, you know, charting that new way forward as to how it interacts with e-commerce. So I think a lot of what that recovery and this buoyant atmosphere from a global perspective is that it's the operational environment's a lot clearer, underwriting's a lot clearer, and we really do seem to be past COVID from a pandemic impact, with the exception of maybe China and parts of Asia. So that's, broadly speaking, an incredibly positive story around investment and real estate globally, but very much headwinds and some clouds on the horizon when we start looking at inflation, tighter monetary policy, geopolitical conflict in Ukraine, and I think particularly on the rates side and monetary policy, particularly relevant to us. We saw very hawkish announcement from Jerome Powell and the Fed yesterday about not hesitating to raise rates beyond sort of neutral. ECB, similar statements a couple of weeks ago. So we really are in this rate cycle that's gonna be a bit more hawkish, and we should expect to see the impact on that. I think from a macro point of view in Africa, the comment earlier around sovereign debt, you know, we've seen this huge weight of capital coming in from Euro bonds up until 2018 and now again in 2021. That is gonna have to have a direct impact into real estate capital markets, and we're gonna talk about that in more detail. So we find ourselves at an interesting time, a bit of a crossroads, both globally, a very positive picture behind us, but a lot of questions, I guess, looking forward to the future. So we're not going to talk too much about the global picture as much as what it means for us here in East Africa. And really just to kick start, I'd kind of like to ask my panelists, you know, from an institutional perspective, I think a lot has been made around the platform story. Ultimately, institutional directors want more indirect exposure and want to have these management platforms that can fulfill their objectives and mandates. Where are we winning and where are we losing, I guess, with regards to this in East Africa? Godfrey, maybe you to start.
Sure, thank you. I mean, when you look at IFC, IFC is a development bank. We have a global mandate, basically, to support, the underserved markets in different forms. I mean, looking at the specific sector where I sit, I mean, the impact that you get is really through platform, is ideally through platforms. A lot of a lot of what we've been doing previous years really been more, through direct investments with developers that obviously meet, the investment criteria. But we are not structured as a retail bank. We more, I mean, as I mentioned, the development bank. So we typically don't work with startups, but I mean, the needs at that level are obviously maybe the most. So the way that we work with the smaller companies is through credit lines, through banks, and obviously, I mean, our colleagues within the financial markets handle that, but I'm more, focused on direct investment. So we've seen, I think, with the prospect of, with the issues their equity. So, I mean, it's really kind of, slowed down our interventions from that perspective. But one way that we see, unlocking this is trying to find ways of working more and more through banks, through platforms, and through, some de-risking mechanisms, because I think we're well positioned to support banks and enable them to take more risk on the basis of standing behind them through some risk sharing. So, I mean, in summary, I would say we've seen a contraction in terms of direct interventions, but there's an opportunity in terms of indirect interventions.
Got it. Pius.
Thank you. Where are we winning and where are we losing? I think when I reflect on the last 6-7 years, my general sentiment is that our biggest pain point in the real estate sector is illiquidity.
Mm-hmm.
There are more opportunity than available capital. If you look at back to 2002, when the Kibaki era regime started, we had a lot of bank financing supporting development projects. But if you look at today, the last 7 years or so, banks have shied away from lending this particular sector. I've been involved in negotiating bank financing for a couple of my customers, and it's a real uphill task because NPLs within the banking sector, one of the primary reasons is because of the real estate. So banks have become really shy in project financing. Another reason is the government bonds are trading at, infrastructure bond is doing about 13%. Rental yields are doing half of that. Capital appreciation the last 7 years or so hasn't been so great. So then it results in some sort of mismatch, and therefore you see there's that pain point. Capital is coming much slower than opportunities that are available in the market. So when I think forward, I think the biggest opportunity is really in securitizing the real estate market. How can we get alternative financing for real estate besides the mainstream commercial banking? And I think that's where the rates come in and other innovative platforms and vehicles.
Yeah.
Yeah.
Great.
Thank you.
Charles, similar experience? I mean, is it a lack of liquidity or sophistication of liquidity to make it work for the local market? Or is it a bit more of a sense of the management platforms and platforms to invest into?
For sure, liquidity is a big pain point. We do interface a lot with the pension scheme monies, and one of the greatest challenge there is at the point where you want to meet liabilities and you have invested heavily, some of them even breaching the 30% allocation. So at the point where then you need to meet those liabilities, especially for shrinking funds, then that liquidity becomes an issue. And then you have another element of you have quite some enormous land banking, and then you need to to unlock the value from those assets. Then you realize that as a pension scheme, the capital you have, you cannot keep on deploying. Then you need also to bring other investors into the play. And just what he was talking about, the platforms and the mechanism through which that capital now comes into that is another major challenge. But I think from the front of, or from the view of the regulatory framework, we can say it's a win. I think the regulators have, in a way, put platforms and mechanism through which this capital can start being pulled in. It's now from the consumers to plug and structure those products that are in keeping with those regulations. Certainly there are gaps in the regulations, but I think the avenues are there. Yeah.
Gerard, I'm sure your view will be maybe a little bit different from a commercial lender with a lot of direct exposure. Where do you see it?
Yeah, First, I'm quite sad about what Piers has said around banks not supporting projects. I hope that we've done quite a bit in the last 2 years, even during COVID, especially supporting some new projects that are in construction at the moment. I certainly believe that at the moment, if I just look at the banks sponsoring this event and some of my colleagues around from other banks, there's a real interest from banks to fund real estate in Africa at the moment. I think the problem from a debt financing perspective, there are two things that's over at the moment. The first one is COVID, and the second one is cheap money. Money is going to become really, really expensive, and that is certainly going to impact project feasibility, not only because of the cost of debt, but also because of the impact that it has, that more expensive debt has on gearing levels potentially.
And of course, compounded by development costs and the actual cost of construction when it comes to development, right?
Correct.
Yeah, my chipping in on this point would be from an investment analysis point of view. One of the previous panelists has mentioned that in Africa, turnaround time on the construction piece is quite high. Actually, I think he said double. And as somebody who's still is in investment analysis for institutional capital, all my other colleagues in the other asset classes have Bloomberg terminals and whatever else that has centralized data. When it comes to real estate, the most basic data is so old, like the housing deficit. I think we picked that from 20 years ago. So I think for investment decision making, while I struggle to build and defend a thesis for deployment into the real estate asset class, or even pitch to an investor, whether local or foreign, my ability to back that up with empirical analysis is challenged. So probably we need to focus on generating this data, collating it, centralizing it, and disseminating it in a manner similar to what Bloomberg and the other asset classes have done for the other providers have done for their asset classes. Thank you.
I think that's a really important topic around transparency on the sector, because that is going to be critical when it comes to giving credibility and attracting institutional, particularly the international component that is not familiar with the sector and is going to have to look and really have a way to how do we benchmark returns and performance for the sector. But David, I think just we touched on it earlier around the sort of structuring and kind of creative ways that we can look at. You know, what are some of the things that you've seen from a finance structuring that you find is working and that can become a bit more mainstream?
Okay, thank you. So I think I'll take a simplistic stab at this, but like somebody has said, real estate is an ecosystem. I'm just trying to model it in a manner that we can easily articulate and then leave the balance of the details for a more lengthier engagement. So from a simplistic approach, I'd want to opine or hypothesize that there are two fundamental risks in real estate. The development risks, that is until the product is delivered, including financing, execution, and all those demons we deal with on site. And then there's the market risk, uptake. So I've had a lot of opinions with respect to, do we have enough scale? Is our demand, that's the market risk, effective? People are willing, all those 60% people in informal settlements are willing to live better. But are they able? So to do this, we need to layer on top the investment structures that will couple the motives of the developers, financiers, and other supply-side players with the motives and needs, real quantifiable needs of the demand side end users. In Kenya, we have just come from the panel or the interview session by VG, my senior colleague, showing that with respect to the strategy, choosing which side of the market has quantifiable demand, there has been a challenge there by the supply side, government or private sector. And that is why we have all the voids that we're seeing, which makes the demand side a bit skittish, and especially debt financiers, but also us who are equity investors, at least on the local front. So what we have done at Gen Africa, for example, is set up the Batian Property Fund, which I'm currently in the deployment stage. And what we are trying to achieve is ensure that on the supply side, we are partnering with developers and other suppliers or supply chain and distribution side players who are able to give us a competitive cost both at the input level and also eventually the product level, so that it is affordable for the segment in the market that needs it. This segment in the market, to use an example, are wage employees. In Kenya, VG mentioned this, about 15, 16 million of the 18 million workforce are informal. So they are daily wage earners, they are weekly wage earners. So when you want to give them a mortgage and you do not want to respect or accommodate the timing of their cash flows, then you'll find that you will hit, you'll come to naught with respect to you trying to penetrate the market. So some of the innovative financial structures should just be similar to what mobile money lenders are doing. We've seen the kind of money Fuliza, Safaricom is able to deploy into the economy. Betting companies. Why? Because it synchronizes its obligations with the earning profile of the target market. Thank you.
Good. All right. Pius, I think you heard from Gerard the days of cheap money are over. I'm not sure it was ever that cheap, but certainly globally it has been. You know, and that story absolutely, to some extent, has been true for sub-Saharan Africa, but we absolutely in a tighter monetary policy going forward. What does that mean for us in the region? There's still, in a lot of spaces in the sector, not that much debt, a lot of pure equity. But increasingly, certainly as you go up the sort of formality of the chain, a lot more debt coming in. What does these higher interest rates mean?
Yeah, thank you. High interest rate is not good for the sector. Already we have been having very high interest rate environment. We have less than 30,000 statistics. We spoke about statistics. Less than 30,000 mortgages in the country of 50 to 55 million people, and the biggest hindrance is the cost of borrowing, because if your rental yield is 8 to 9, even to 10%, and you're borrowing at 13%, then you can start understanding why we are living in a rental-driven market. Because if that tenant transitions to the land to become the landlord, there's going to be money leaving the pocket instead of money coming into the pocket. So if interest rates go even higher, then we are saying that's going to impact the very people that we're talking about here, that we really want them to have a stake in the real estate sector. The other thing is for investors who've put in money in real estate, or rather they are already invested, then it's going to put pressure on valuations. Because if I have $1 million that I need to allocate, the question will be, to which asset class should I allocate it to? Do I put it in bonds, government bonds, or do I put it in real estate? So then you'll see new investors demanding a higher rental yield, which means for the existing investors that could mean a haircut, which is not pleasant. It could also bring up a possible third scenario, a lot of wait and see. And I keep saying, I think there has been a lot of talk in this country, when is the bubble going to burst? But if you look at the household sector, how real estate is owned, it's primarily driven by equity more than by debt. And therefore, even when the valuations are unreal, if I may say, in quotes, people have that patience. I'm going to wait until things turn around to my expectations. So we may also see a third scenario of wait and see. Yeah, thank you.
Charles, I guess a similar take in terms of those scenarios. I mean, where do you see it? Because I guess it's really important to kind of understand that, okay, from an institutional capital, there's a lot of debt and reliance on debt capital markets, but actually, if you take a step back and look holistically at the entire real estate sector, not as much as what you would have in a more mature market. But I guess I keep coming back to that sovereign debt, and we can't kind of, the impact on the economy. I mean, how do you think that's going to play out and spill into the real estate sector?
Sure. I think David has talked about the structures that we use to channel the capital. And one of the emerging trends now, and I think Pius can bear me witness, is the joint ventures that have been there. You're now beginning to say that you want an EPC contract. And now people have moved to, I want an EPC, but I also want the financing component to that contract. And the key question is, what is the cost of that money that is coming to finance the project? And whether it is borrowed locally, whether you have imported it from another place, there is still that huge debate around the cost of that money, because it will have a direct impact on the cost of the product that you're going to deliver. I do not know what the cure to all of this will be, because we have a government that is looking to finance its operations. And when they step into the market, they step in and give very competitive and compelling returns. So when somebody is benchmarking their investment in your project, they're starting from a pretty high level. As Pius was talking of 13%, for example, for an IFB. Then you're saying that they need to put their money in a real estate project. They will certainly demand for more. So there is that risk. But I think over a longer period horizon, I would still believe, especially for people who are into project development and they have ability to talk to project financiers and get lower than the normal operating interest rates, I think there's a lot of scope for EPC and EPCF contracts so that you can unlock the value of a lot of these projects and especially land banking that is existing.
And I think the lenders will like that comment as well, just around development risk and kind of mitigation that can come with an EPC contract. Godfrey, I guess still keeping the theme of rates and where we are, but very much kind of looking now going forward and what sectors or geographies are you most kind of excited about, or where the most appetite is from a development point of view as the IFC?
For us, I mean, the important thing is, the key aspect is, focusing on underserved markets, typically providing or supporting supply where there is a real gap. I mean, there's a difference between, for example, I mean, I'll give a typical example. If somebody were to come to me and say, you know, I have a hotel project that I need you to fund in Nairobi, I mean, you first have to look at the supply-demand dynamics. Is this a mature market? Is this an oversupplied market? What is the oncoming supply? So we take that seriously into consideration in making an investment decision. So that obviously determines where we can make an investment and ensure that, you know, there is sustainability in the market. Obviously, we are not in a position, or we don't want to be seen to be competing with commercial banks, because that obviously is not market development. It's unfriendly to the environment. Ideally, in a situation where things work, we should be working ourselves out of the market and leave the business to, you know, the financial institutions in the market. But that's an idealistic situation. So the need for IFC or development banks will always be there. But where we see a lot of opportunity is around affordable housing. I mean, I mentioned the hotel market in a number of capital cities is well supplied. So secondary cities is where we look at. But affordable housing, I think, is a key sector. It's got, I mean, it's a no-brainer from a supply-demand gap perspective. I think Ken from Centum did mention this, the gap and the growing deficit. People are being born every day. Developers can't build at the same rate. But the challenge is always the affordability component that was mentioned. Building a house at a cost that, you know, can be absorbed by the market. So I mean, if you go purely on commercial lines, I think it will take a lot of time for, you know, for housing to trickle down into the market. So you need some element of concessional funding. But concessional funding as well should be used in a situation where it's temporary transitioning to, you know, a market economy. So there are elements in which we look at, you know, that kind of support, but that comes from donors. There's only a limited, you know, capacity within donors, given what the market is. And for us, you know, we are not really a concessional financier, because we raise our money on international capital markets. We're also not expected to distort markets to unfairly compete against commercial banks.
No, that's great, and I think the theme of affordable housing is going to be a big one, and it's you can't talk about institutional capital and not talk about it, I guess, because of that scale and that it presents. Gerard, from a Nedbank point of view, and obviously a bit more kind of exposure to the rest of the region as opposed to East Africa, how does the opportunity stack up versus, say, South Africa, West Africa? What is the opportunity for affordable housing in East Africa specifically?
I think housing is a theme right across the continent. There's a shortage of housing, and not just physical housing, but also the mechanisms for people to get into housing, whether it's rental or buy-to-rent structure or installment sale type structures or outright acquisition. So I think there's a long way to go from a financial engineering perspective to get the right products in Africa. I think South Africa is obviously quite a different market with a very sort of prevalent sort of mortgage market for people to buy houses, but Africa's got a long way to go. And then just coming back, you know, you mentioned rental. I mean, an obvious solution would be rental housing, but the issue is, like a lot of people mentioned, is the cost of debt. And the problem with cross-border debt is it will be expensive, not only because money's getting more expensive, but it absorbs the risk profile of the country. And unfortunately, I mean, like we saw this morning, the debt levels in the last 2 years of a lot of countries have increased, and that impacts their risk position, and hence that also drives the cost of debt from a cross-border perspective, at least.
Or, Gerard, maybe just a follow-up question then, and then, you know, certainly at a global level, ESG is a game changer from a real estate point of view. We've seen huge amounts of capital being raised, with 40% of the world's carbon emissions coming from the built environment. We obviously have to make this transition, but as an instrument from a capital perspective, how are you finding it, or what are the ways in which, and certainly kind of can improve from an ESG funding point of view?
So I think there's definitely opportunity, in fact, lots of opportunity for things to develop from an ESG funding perspective. Netbank, I mean, we mentioned it briefly this morning, Netbank together with the IFC recently raised a green bond specifically supporting the affordable housing market in South Africa. A bond was raised to provide funding to developers to develop affordable housing specifically. I think what I would like to see is the delta between raising funding, green funding, and let's call it normal funding, is not big enough to really pass on to developers and to make a gigantic leap in terms of taking a project that would not be feasible in a normal funding structure to something that now completely makes sense. So I do think as the pools of liquidity become more and more aware of the importance of ESG, I think we will see a larger differentiation in pricing that will impact projects going forward.
Great. Yeah, David, I guess follow on from that. I guess a lot of domestic ESG funding absolutely is very expensive, but from an international perspective, I mean, the S in social from a affordable housing perspective has got to be unmatched, right? And I guess broader investment, development, impact from a real estate investment in Africa, it's got to be a compelling story. I mean, what do we need to do to be attracting some of that global ESG funding for the sector?
Thank you. With respect to, I'll speak from my own experience at Gen Africa, where we've actually worked and partnered with FSD Kenya, and they're helping us build that ESG component in our investments. And what I can say with respect to my perspective from that experience to your question is, I think the communication element can be improved